Good morning, ladies and gentlemen, and welcome to this webinar on inflation trends and outlook in Latin American partially dollarized economies. We're going to share the vision of central bank representatives. This is hosted by the Development Bank of Latin America, CAF, and the Latin American Reserve Fund, FLAR. We are delighted to have such keynote speakers. We're talking about chief economists or representatives of the central banks of Paraguay, Uruguay, and the Dominican Republic. This is a great opportunity in order to share experiences and the vision of the technicians responsible for monetary policies in economies that face additional complexities in managing inflation and financial stability due to the high degree of dollarization. Today we're going to talk about monetary policy measures that have been implemented in each four countries represented at this webinar today and how they have impacted inflation and recent financial stability. We will also talk about short-term outlooks. So we would like to extend our gratitude to Alfonso Alfaro, the Director of the Economic Division of the Central Bank of Costa Rica, Sebastián Diz, Research Economist at the Central Bank of Paraguay, Joao González, Deputy Director of Monetary Policy and Economic Studies at the Central Bank of the Dominican Republic, and Adolfo Sarmiento, Head of Economic Policy and Markets at the Central Bank of Uruguay. We're going to have different rounds of intervention that will be moderated by my colleague Rainier Schlesser, Chief Economist at CAF, and myself. So let's get started with the first round. During this round, we are going to listen to each speaker talk about the monetary policy measures that have been implemented in their countries and how they have had an impact on inflation and recent financial stability. We're going to get started with Alfonso Alfaro, Director of the Economic Division of the Central Bank of Costa Rica. He's also a professor at the Costa Rica University. He's part of the Economic Policy Committee for Economic Development in that country. So thank you very much, Alfonso, for joining us today. So you have the floor in order to share with us the experience in Costa Rica. Thank you very much, Carlos. And I would also like to thank all the attendees at this webinar today. Let me get started by sharing my screen. I hope that you can all see my screen correctly. I hope that you can see it well enough. So thank you very much for allowing me this opportunity. I believe that sharing experiences in our economies might be very useful for those working in other regions and for other central banks. Let me start by providing you with a context. What has happened in Costa Rica within the framework, of course, of international developments. Back in 2022, we experienced an inflation shock that was also commonplace around the globe with a sharp increase of inflation. In the case of Costa Rica, we should recall that for a couple of decades, our inflation rate was normally a two-digit rate. We're talking about 10 to 20% approximately, and it was kind of difficult for us to overcome that inflationary trend because it was almost impossible. We didn't have an independent monetary policy in place because our exchange scheme was established every day on a floating basis, and as a result, we couldn't control our monetary policy. Afterwards, in 2016, when we began to decommission that scheme, the markets approach was more flexible, and we began to implement a new monetary policy. As a result, in the past decade, we were able to reduce inflation down to a reasonable level. Our target is 6%, which is the average of inflation of our commercial partners, and we have a tolerance threshold of plus minus 1%. At the onset of the pandemic, we were affected by an inflation shock that was rather low, but in 2022 and in early 2023, we were impacted by inflation just as other countries did, as you can see on this graph. Now, when presenting this graph, we can see that we experienced a reversal. We're not talking about price variation or an inflation variation. We are talking about a price reversal rather. Right now, our prices are tantamount to those reported in the first half of 2022. The price index was reversed, and as a result, when we establish year-on-year inflation, our inflation happens to be high, for example, in 2022, but now it's negative in 2023. Right now it stands at 0. So it was slightly positive in the past 2 months, but it's near 0, and we are also at the lower band of the 2%, which is our target. That is our goal. We aim at that target by early 2025. A quick aside, this is an explanation of why things happened that way and why inflation was not so persistent as it was in other economies. This was a result of several developments. First off, prior to the pandemic, we had gone through a very significant fiscal consolidation process. As a result, and during the first stage of the pandemic, the executive power did not have much leeway in order to increase expenditure, as it was the case in other countries. There were also other energy shocks. For example, hydrocarbon prices also had an impact. In other countries, people were granted subsidies in order to mitigate the impact. In our case, it was a little bit more complicated because we didn't have any such subsidies in place. As part of the new reform, there was a public service law that was passed that together with the fiscal reform led the salaries in the public sector to remain more or less at the same level for the past 5 years. This might have contributed to reversing price levels or the inflation rates reported. This is therefore an overview of what I have just described. As you can see, there was an increase in the prices of commodities and some supply chain disruptions. As a response, as a natural response by central banks in the face of such shocks, a restrictive global monetary policy was put in place. So all central banks could use such tools. The reason why we have reported negative inflation rates might be afforded by the explanation I have just provided. During high inflation at the beginning of the COVID pandemic, our monetary policy was expansionary. We reduced our monetary policy rate to the lowest level. We're talking about 0.75%, with a temporary reduction of the minimum legal banking reserve level by 3 percentage points, all in line. We also had some loan agreements with the IMF, and we also performed some foreign currency sale. Usually foreign currency comes to the country from exports and tourism, but at that time tourism was at a very low level. Now the natural response of the central bank was to adjust the monetary policy rate to 9% between 2021 and 2022. We reversed the minimum legal banking reserve, and we began to manage liquidity over the period. We also received an external grant from FLAR in the amount of $1.1 billion, and there was also supply of debt instruments denominated in foreign currency. Now that inflationary pressures have been reversed, we have experienced a significant reduction of the monetary policy rate. Right now it stands at 425 basis points, which is low, taking into account the global context, and especially in an economy such as ours. There have been some changes as to how the minimum legal banking reserve should be managed. Right now we have quite a significant liquidity volume, and we have tried to manage liquidity by establishing loan terms for our monetary policy. And in closing, we have also reported the highest historical level of international monetary reserves that have two-folded in 2 years. This is a very significant aspect that has also taken place in Costa Rica over the past years. And now I would like to stop here to give the floor to the next speaker. Great, thank you very much, Alonso, for your presentation. So there has been a significant decrease in price variation as depicted in your graph, and you have explained the reasons behind that. No doubt, and I would like to highlight that one of the aspects that has contributed to the monetary policy through different instruments are related to a fiscal adjustment process that supported the monetary policy over this period against inflation, especially taking into account spending. So it's very interesting because this is something that is being applied in the different economies. Now we're going to move to the central region of Latin America, and I would like to give the floor to Joel Gonzalez, the Deputy Director of Monetary Policy and Economic Studies at the Central Bank of the Dominican Republic. Before, he was a director of the Monetary Programming Division of Economic Studies. He was also professor at different universities in the Dominican Republic. Joel, please go ahead. You have the floor, and thank you very much for joining us today. Thank you very much, Carlos. Could you please confirm that you can see my presentation on the screen? Thank you very much for inviting me to take part of this interesting event. I would like to greet all attendees today. Now, with regard to the Dominican Republic, I would like to kick off my presentation by giving you some context as to dollarization and how it affects our country. The dollarization is very important for us in terms of monetary policy fiscal terms. That has been limited, however, over the past years. For example, the degree of dollarization of deposits and loans in the financial system has remained stable between 20 and 30%. Then we could also speak about the exchange rate pass-through to inflation. We have some target rates established for inflation since 2012. The impact of the exchange rate pass-through to inflation has been slashed from 60% to 25% approximately. At the same time, we have observed how inflation expectations have stabilized, or there has been an anchoring of inflation expectations. However, 60% of public debt is denominated in foreign currency. Therefore, this remains a very important aspect with regards to policy making. The Central Bank of the Dominican Republic, in consultation with the government, has established a number of measures in order to respond to the inflationary pressures that took place after the pandemic. So we're talking about a combination of economies that were growing faster compared to other economies in the world. And there was also a supply shock. The combination of policy was quite effective. Headline inflation was reduced, as well as the core inflation was reduced. Our target stands at 4% with a plus 1 percentage point above that target. Now, the government, by implementing a grant scheme aimed at mitigating the effects of oil price increases, has been able to reduce the impact that this could have on transportation and housing. In 2021 and 2022, the impact was more than 3 percentage points over the headline inflation rate. All in all, the monetary policy began to react as of November 2021 after a gradual increase of 550 basis points in the monetary policy rate. As a result, we were able to mitigate the effects on the side of demand. Together with these fiscal measures, it was possible to consolidate the fall of inflation. I have spoken about the anchoring index of inflation expectations. We want to move to the center of our target. This has enabled the monetary policy to react on a timely basis. And on the other hand, the exchange rate was also a shock buffer. This could be materialized through the implementation of some derivatives that exerted pressure on the exchange market, allowing for more exchange rate fluctuations. In this context, we have observed that price formation has a forward-looking approach where handling expectations correctly is very important. Monetary policy measures have also been passed through to the rest of the economic variables. As a result, it was possible to achieve some recovery. Right now, we are growing by 5.1%, which is close to our potential growth rate. Now, the occurrence of these shocks in the implementation of monetary measures that were non-conventional led the central bank to monitor the financial stability indicators more closely. Now we pay attention to all the measures that have been implemented during the pandemic, such as monetary stimulus measures. We also take into account default rates based on different exceptional measures such as provisions that have been granted during the pandemic, and the Financial Stability Committee has also been put in place. This committee issues a report and runs stress tests in order to take into account adverse economic effects as well as the effect of adverse climate changes that could have an impact on the financial system. Thank you very much. Thank you, Joel, for your insights. You have made quite clear the challenges that the Dominican Republic economy had to face and how dollarization affects price control and the role played by the banking system and how all this has been kept under control. You have also thrown some light at the exchange rate pass-through to the headline inflation and its effect, and how monetary policies have made it possible to keep inflation expectations unaltered, and how inflationary pressures could be controlled. You have also spoken about the price of services and how they behave similarly across the globe, and that could be something that global economies might take into account going forward. Now we're going to travel southwards, and we are going to give the floor to Sebastian, this research economist at the Central Bank of Paraguay. He was an economic researcher. Sebastian, you have the floor. Please go ahead to talk about the experience in Paraguay. Good morning. First off, thank you very much for allowing me to participate. And I would also like to thank all attendees for joining us today. Could you please confirm that you can see the presentation, asks the speaker. Now, if we take a look at the recent evolution of inflation in Paraguay, there were some outside factors that account for the evolution of inflation, a number of shocks that have led to the increase of international prices of both oil and food products. As a result, we reached an inflation rate of 12% by the end of 2022, which is far above our 4% target. We had not experienced such inflation rates since the end of 2000 or beginning of 2010, when there was an increase in food prices internationally. As a result, we have also faced some other relevant internal or domestic shocks. We were affected by a severe drought in 2022 that curbed the supply of foodstuffs, exerting further pressure on the price of such products or goods. Now, in response to this, the Central Bank of Paraguay decided to increase the monetary policy rate. The policy was quite expansionary at the time due to the COVID pandemic. As a result, the Central Bank decided to increase the monetary policy rate up to 8.5% in 2022 from 0% in 2021. Other measures were also adopted. For example, a tax reduction was applied to to all byproducts, even though this did not have a direct impact on inflation. So we were able to reach this 4% inflation rate by mid-2023. So it was quite a quick reversal, and there were many contributing factors. On the one hand, the interim nature of the developments we experienced, also the fact that there was a very effective, quick pass-through to banking interest rates, the anchoring of inflation expectations was also very well handled, in our opinion. In fact, we could observe that sometimes inflation was reaching up to 12%, but nonetheless, our inflation expectations at the time were slightly above our 4% target rate. I should also underscore that inflation was curbed without having to slow down our economic activity sharply. The labor market data during the period remained robust, and there was no significant production loss over the period. So all this also bolsters up our theory that the anchoring of inflation expectations was very important to make sure that inflation could go back to normal levels. Against this background, we can say that right now inflation is near its target rate in Paraguay since mid-2023, and right now the monetary policy rate has also reached the targeted levels. I should also say that the increase in food and energy prices and their pass-through to the economy had some second-round effects. In this respect, we have observed that this pass-through was limited on the one hand, and this is shown when we take into account the IPC EAC report. This was, however, an inflation that did not persist much because we were able to go back to our target rate of 4% rather quickly. If we now take a look at the financial sector right now, this industry stands on a very sound basis with good credit quality, profitability, and solvency indicators. Some indicators had been hit during the pandemic, but then these indicators went back to normal. As a result of these indicators having improved, we have observed no significant, they have not been affected by the disruption of supply experienced lately. And they were not affected by the policy that the central bank had to implement in order to curb inflation over this period. Thank you very much, Sebastian, for summarizing the highlights of the evolution of the monetary policy and inflation, as well as financial stability in Paraguay. We observe how inflation has been reversed to the target rate thanks to some short and medium term measures. And we also observed that this all happened when some outside shocks and domestic shocks took place. For example, the drought that you have mentioned that exerted a lot of local pressure. But thanks to the work performed by the central bank technicians and authorities, that situation was adequately dealt with. Now we're going to give the floor to the next speaker from the Central Bank of Uruguay, Adolfo Sarmiento, who is the head of economic policy and markets at the Central Bank of Uruguay. He's also the head of the implementation of monetary policies in Uruguay, and at the same time he works in the area of fintechs. He is involved in CBDC projects at the issuing institution. Thank you very much, Adolfo, for being with us today. You have the floor. Thank you very much, Carlos. I would also like to extend my appreciation to all attendees for their interest in this webinar. Since I'm the last speaker, I would like to pinpoint some common elements that we all share because we have gone through international cycles that have affected us in a similar fashion across the economies. I would like to underscore some highlights of the Uruguayan economy. In Uruguay, the economy is partially dollarized. There are still high levels of dollarization in Uruguay. As a result, in recent years, the government has implemented a number of measures so that together with its monetary policy, the country could promote or foster de-dollarization. This slide shows the overall framework of the monetary policy in Uruguay. That is a strong commitment to reaching low inflation, also the interest rate as a monetary policy instrument. And then another aspect that has become increasingly more important for central banks. I'm talking about something that has to do with the development of markets in local currency. And this has to do with strengthening the transparency of communication. There are several initiatives that have been put in place in order to reach out to all the target groups that are affected by inflation, and also in order to understand the cycles that we have gone through during the COVID pandemic and after the pandemic. Also, the conflict of the Russian and Ukraine war and their effect on international prices. In Uruguay, at the end of 2022 and in early 2023, the country was hit by a very severe drought, the worst in the country's history. So, at the same time, the central bank was implementing a very contractive monetary policy to deal with the effects of inflation. All stakeholders, however, were communicating or sending a clear message in a very assertive manner and with regard to inflation expectations. As I mentioned before, in a dollarized economy, the de-dollarization process promoted by the central bank, not only in terms of debt management, but also in terms of macroeconomic decision making. And as our colleague from the Dominican Republic pointed out, there was a special focus on strengthening the derivatives market and the foreign currency market with free flotation. In the case of Uruguay, this was important. In the past, the intervention of the central bank in the foreign currency market was quite significant, but over the past 4 years, this has been one of the highlights in the country. So in the context of a dollarized economy, and I don't want to repeat what other speakers have said, I would like to mention that this has an effect not only on the financial system, but also on macroeconomic decision making. In this regard, this more assertive communication that I mentioned before has made us stronger. Now, let me move to the next slide regarding decision making on monetary policy and interest rates. This is similar to what other countries reported in 2022. And due to the rise of commodities prices internationally, we reached a high inflation rate near 10%, with to be followed by a contraction monetary policy. We now stand close to our target rate, and we are going through another cycle due to the aftermath of the drought. Over the past year, we have been reaching our target of 5.4%. As I mentioned before, there was some reluctance on the part of inflation to go down, but right now these have been controlled by the policies put in place. I'm running out of time, so I would like to finish by pointing out something that was not mentioned before. In the specific case of Uruguay, this is very important. The inflation phenomenon in Uruguay, if we take a look back, has been marked by inflation inertia. Now this has been argued once again because after the high inflation period reported in 2022 as a result of the pandemic and the Ukraine-Russia war, some countries are starting an inertial situation. But in the case of Uruguay, since over the past 20 years, we have reported persistent inflation. This inertial process was commonplace in the country. Therefore, this monetary policy, and thanks to communication and the analysis of expectations, we have been able to grapple with the situation. Thank you. Thank you very much, Adolfo, for sharing with us the highlights of inflation behavior in Uruguay. It's quite clear that it has been quite challenging for Uruguay managing this variable, as well as the commitment on the part of the monetary policy representatives in order to reach the inflation target rate. As you mentioned, when closing, the Uruguayan economy shares some characteristics with other countries in the region in terms of indexation. Fortunately, recently this has been adequately limited, and now we see how inflation expectations have been converging to the target range. However, this is something that is part of your day-to-day work. You have also spoken about how communication has been promoted in order to influence inflation expectations. So with us come to an end of the first round of insights. We have therefore discussed some past and recent developments, and let me point out three conclusions. There is a cross-cutting argument here, and that is that monetary policy frameworks had been advanced by central banks across the region in order to influence on inflation behavior. And this has been observed, of course, in each country with their own peculiarities, but this is a cross-cutting element. The central bank representatives that have been presenting today have spoken about how they had to deal with supply shocks, both global and local shocks. Therefore, some of them had to deal with them both sequentially and in parallel. Some of you have referred to the fiscal component. The fiscal policy has to support monetary policy when it comes to price control. This is, of course, of the utmost importance for economic and financial stability. Central banks have also shown their commitment, and they have guaranteed that they are not going to allow for persistent high levels of inflation. However, there are different pressure aspects that still persist, both internally and externally, that affect the possibility of keeping inflation under control constantly, especially in such an uncertain global context, especially due to the escalation of tensions. But I don't want to announce any spoiler here. That's why I would like to now give the floor to my colleague Rainier. Thank you very much, Carlos. We are now going to start with the second round. The purpose of this round is to provide a forward-looking view. We would like to take advantage of such keynote speakers in order to deep dive into their view about the effect of inflation in the short term, with a special focus on identifying the key risks and challenges that are envisaged. We are going to be talking about forecasted inflation, both in the short and medium term, as well as inside and outside factors that the speakers may be worried about when it comes to controlling inflation. We will also talk about the key challenges that the monetary policy in their countries is facing, and we will also talk about some lessons learned in terms of monetary policy in these partially dollarized economies in the past 4 years. We are going to change the turn of intervention now. We are going to start with Sebastián Diz, who will talk about the situation in Paraguay with regard to these topics. Please go ahead, Sebastián. Thank you very much, Rainier. Well, going forward, our forecasted inflation for 2024 and afterwards at around 4%, which is in line with our inflation target rate. Now, this forecast is based on the fact that right now inflation already stands near the target, and it's also due to the lack of relevant shocks, both inside the country and outside the country, at least in our central forecast scenario. However, there are certain upward risk factors for inflation. There are outside and internal risk factors. Among the outside risk factors, we can mention the escalation of geopolitical tensions in the Middle East or an increase of food prices due to adverse climate effects. Another outside risk factor could be, for example, a restrictive monetary policy in the United States, even though this risk seems to be disappearing recently. As for some inside risk factors, we could point to an inflation acceleration due to climate conditions. We foresee the La Niña phenomenon. We believe that it's going to hit the country, and this phenomenon is normally connected to droughts and therefore a phenomenon that exerts pressure on inflation due to the shortage of certain foodstuffs. Taking a look at these climate shocks, however, we can say that recently they have not had a significant impact on the price of food products, and they will not, they are not expected therefore to affect CPI significantly, but these drought periods could affect our exports eventually, and therefore had an impact on our current accounts, and therefore exerting pressure on our foreign exchange rate. Now, let me talk about the monetary policy in management approach in a dollarized economy such as that of Paraguay. Right now, Paraguay reports relatively high financial dollarization levels. I'm talking about deposits and financial instruments. So the prices in our economy are normally fixed or set in home currency, and transactions are normally paid also in a local currency. If we take a look at this financial dollarization process I have just mentioned, we observe that these levels have come down over time gradually. In the past, dollarization was in excess of 70% in the 90s, and now it's down to 45% approximately. This de-dollarization process has happened as a result of the fact that our macroeconomic factors have become more stable. Dollarization remains relatively high, however, it has not been a roadblock to the functioning of the country's monetary policy, and it has not posed a risk to our financial sector. In Paraguay, our financial sector has a good hedge for assets and liabilities in US denominated instruments, therefore mitigating any negative effect on the country's balance sheet. On the other hand, usually the financial system grants loans to companies that earn revenue in dollars. As a result, there's no credit risk that could result from the fluctuation of foreign exchange rates in the case of companies that trade in a currency different from the US dollar. Right on top of this slide, you can see that half U.S. denominated credits in the financial sector are targeted at the wholesale sector, the farming sector that normally generate revenues in dollars. Then at the bottom, you can see that a low percentage of U.S. denominated loans are targeted at companies that do not generate dollars. Only 20% of U.S. denominated loans are granted to companies that do not generate U.S. revenue. This characteristic of this hedging of the financial system in Paraguay has been key to make our financial system resilient enough in the face of some sharp shocks on the foreign exchange rate. In Paraguay, when we left the high commodities price cycle back in 2020, we went through some significant foreign exchange fluctuations, but our system remained resilient all the same. This financial dollarization has not been or has not meant any limitation to our stability, because since the financial system is well hedged, the central bank does not need to worry about the effect of the monetary policy on the foreign exchange rate. On the other hand, we have a successful track record in controlling inflation over the past years, which is a good sign to the fact that dollarization may not have hit the effectiveness of the country's monetary policy negatively. And that's all. Thank you. Thank you, Sebastian, for sharing your insights about inflation rates and inflation outlook. So the expectations are right now anchored with a risk balance that is quite positive, but with a more ample range, given the structural characteristics of the Paraguayan economy. So the lack or the absence of this mismatch in the balance sheet of the financial system has been a hedge that the system has had, given more leeway to the monetary policy of the country. Now we are going to move on with Adolfo in Uruguay, who will share his experience with us. Could you please show the remaining slides? Taking into account short-term projections and the ones that have been included in our monetary policy report that has been released lately, we hope that our baseline scenario, which already prices in some risks regarding commodity prices, and some potential medium-term effects on the supply of energy. However, if we take into account our monetary policy in the next 24 months, we keep our inflation forecasts unmodified. Right now, our expectations are within the target range, and taking into account that the monetary policy rate is neutral as we speak, we can say that our inflation situation remains stable. Nonetheless, we conduct certain analysis regarding both monetary policy and financial stability. We normally analyze this data based on a risk map. This slide shows an international risk map. The highlight being the geopolitical risks that we take a close look at on a regular basis. I'm talking about services and logistics, because these elements have proven to be quite volatile as of late, and they have some impact on inflation. So number 5, as you can see here, is in the red zone. All other risks that we can identify in the international arena and that might be concerned with macroeconomic variables such as the interest rates or the monetary policy rate in the United States, all those elements are in the green to yellow areas. As a result, we believe that our projections are resilient enough if we take a step further or going beyond this international map. We observe some risks similarly to the case of Paraguay, such as climate effects. Paraguay and Uruguay are in the same region, so La Niña could also hit Uruguay, leading to some drought negative effects. However, all these factors have been priced in our baseline scenario. Uruguay faces yet another challenge. If we take into account both the fiscal and monetary policies and macroeconomic coordination, in Uruguay, a consolidation scheme has also been put in place for fiscal targets. As a result, the country has undertaken this approach as a necessary approach in order to improve our risk rating. We have been minus triple B to plus triple B country. Our challenge going forward is to obtain a double A rating. That is to say, we want to increase our rating. This is a necessary condition to that end. And with regard to dollarization, and apart from the fact that the financial system is highly solvent, furthering financial instruments in local currency and derivatives in foreign currency, such developments have made it possible to manage this coordination without dollarization being a reason for concern. Nonetheless, the Central Bank of Uruguay has been promoting a number of measures. It has been raising awareness about financial management, or the kind of financial management we should carry out to secure that the economy remains healthy, even though most stakeholders in this case are involved in foreign trade. Nonetheless, people continue to think about saving in foreign currency. This is, of course, one of the challenges that we still need to face when conveying our message in a transparent manner. Going beyond the short or medium term, we should therefore promote further development of markets in local currency. Thank you very much, Adolfo. It's quite revealing to observe that when talking about risks, you refer to international risks mainly, which shows how important dollarization is and the impact this has on the foreign exchange rate. You have spoken about geopolitical risks, monetary policy risks, also idiosyncratic risks. Nonetheless, we should also emphasize how the domestic financial system limits impact thanks to its sophistication and development. I think that this is one of the takeaways of your insights. Next, we're going to travel back to the north and we're going to give the floor to Joel, who will speak about the case of the Dominican Republic. Thank you very much. I hope that you cannot hear me. My apologies, I had some technical issues on my side. Felipe, please go ahead with the second part of my presentation. Now, with regard to our outlook going forward, according to our forecast model, as you can see in the next slide, we foresee that inflation will remain within the target range. Right now, our inflation, our headline inflation is near the lower band, and we believe that it's going to be near the 4% target in the next monetary policy horizon. With regard to core inflation is right in the center of our target with a gap that has been breached as of late, but growth is still negative, therefore we do not see any additional demand pressure. In this case, there is a risk component nonetheless. I'm talking about the volatile component on non-core inflation. The volatile component of inflation is right below the lower end of this target, and this exerts pressure upwards. The speaker apologizes because he believes that his camera is not on. Could you please confirm whether my camera is working? Next slide, please. As I mentioned before, there are some risk elements that push the balance sheet upwards. Some outside risks, such as the increase of commodities prices. If we face a scenario of oil prices standing at $20 per barrel, this would push our inflation by 1 percentage point in terms of our forecasted inflation. There are other risk factors that can be identified locally, such as implementation of some structural reforms that have been announced by the government, fiscal reforms, or reforms in the electricity sector that could push costs, production costs, that could eventually have an impact on the price of finished products. Over the past years, and given our geographical position, the Dominican Republic is normally sensitive to extreme adverse climate phenomena, we have been hit by droughts and hurricanes that triggered some supply shocks with a special impact on farming products. And that, of course, increases the risk of pushing inflation up. Next, we can see some of the key challenges that are related, for example, to the prevalence of supply shocks. Based on some studies, we can conclude that 50% or in the Dominican Republic, these shocks have affected inflation by 50%. And sometimes this depends on how temporary that supply shock is and the response we provide to it and how we coordinate the different policies. Another challenge has to do with non-conventional policies that were put in place as a result of the COVID pandemic. Due to these sequential shocks, they could be applied more frequently. For us, decommissioning these non-conventional policies has been quite a challenge, and also controlling the impact they could have on the balance sheet of the financial system. And of course, it has also been a challenge setting the criteria going forward. We also need to identify the shocks, and we should analyze how this will affect the non-observable variables such as GDP. This also determines how monetary policy should behave going forward. As for the lessons learned, in the next slide, you can see that since we did our homework in terms of monetary policy, all this bore fruit, and the bank was able to react adequately and on a timely basis in the face of all these shocks, introducing new economic and financial instruments. Given the impact of supply shocks, we had to coordinate our fiscal policy. We also had to implement macroprudential policies, and we also had to implement a communication policy in order to communicate to the markets the reasons why we reacted in a certain manner in order to keep expectations within the target range. Thank you very much, Joel. I believe that the case of the Dominican Republic is quite interesting. That is the prevalence of supply shocks and the challenge this has posed to the monetary policy. It's also interesting to see how monetary authorities were able to face this challenge by coordinating their work with that of fiscal policymakers. This is an additional aspect to be considered and which sometimes is not included among traditional components. But we can see that the monetary policy has become sophisticated enough, and therefore this is quite a critical element that cuts across the monetary policy in the country. We are going to come to the end of this round with Alonso, who will talk about the situation in this regard in Costa Rica. Thank you very much. Well, let me finish off this context. This has been part of our public debate in the past 2 years. We have observed quite a high level of foreign exchange supply, leading to the local currency depreciation. In 2022, the foreign exchange rate was 700, and right now it has been revalued, which is in line with a significant volume of foreign currency in the country. The central bank in Costa Rica has twofolded its reserves, even during the most important negative shock when reserves were lost, but now such reserves have been recovered fully. Since there is such a high volume of foreign currency, the central bank has been buying such foreign currency. Right now, the foreign exchange rate stands between 520 to 540 colones to the dollar, which is quite a good value. Now, in this context, and by comparison with other current countries, I should say that there has been an increase of monetary aggregates dollarization. We see such an increase in dollarization in most of such instruments. Central bank representatives observe an increase in the speed at which loans in foreign currency are granted to the private sector. There has been a year-on-year growth of 2 digits. It calls our attention that when breaking this down, such loans are somehow exposed to the so-called foreign exchange risk. And this somehow is the opposite of what other speakers mentioned before. On the other hand, we observe that there has been a good pass-through in terms of passive rates in the financial sector, but not so much in the active rates. In some credit categories, for example, in the case of credit cards or debit cards, the reduction has been very, very small or almost nil. So what really calls our attention is that this is a virtually counterintuitive result, so to speak. This poses a significant challenge to implementing the monetary policy. We have also observed over the past weeks that the award or the reward for saving in colones has been negative, which would trigger off an alarm. We have said we cannot constantly give a negative reward on saving in the local currency for too long. Therefore, however, we have been able to remain rather stable despite this negative reward on savings in local currency. What about our inflation-related challenges in Costa Rica? In Costa Rica, inflation has been negative according to this baseline scenario during 2022 and 2023. As a result, we have our year-on-year growth has been negative. We believe that we should reach the tolerance range in Q1 2025. And as a result, we will be able to attain the target that we have committed to deliver on with society. Now, during this period, core inflation has been almost zero at some point in time, but it has never been zero at 100%. Actually, it grows gradually over time. We do have some challenges, and if we summarize all the elements I have described, we can see that there has been local currency appreciation due to exports, tourism, and FDI, which provides further stimulus to investment. However, we would like to attain our inflation target as quickly as possible. Sometimes attaining everything at the same time with no foreign exchange exposure at all is rather difficult, because actually prices have to also grow according to our target, but very often all these elements pose a challenge for our monetary policy. There has been a slow pass-through of our inflation rate to prices, but monetary policy always takes a forward-looking approach, and all the risks described before are the same risks that we face in Costa Rica. That's why the central bank or the board cannot actually reduce the inflation rate faster, especially in the global context. Finally, we have committed ourselves to delivering on this target. And these are some of the highlights that I would like to share with you. We need to communicate the macroeconomic performance that we have achieved. We have to report on the results to society. We have failed to do so effectively over the past years. We have been able to grow in quite a reasonable manner, more or less at a 4% year on year. And this year we also expect to grow by 5%. But this is not actually what people perceive. Thank you very much. Well, the case of Costa Rica is really very interesting. We have observed how the inflation rate in the country has reacted. There is a time coincidence with the local currency appreciation that's pretty evident. But of course, the different economies in the region, especially those that are partially dollarized, will have to handle revenue coming from exports or foreign direct investment. All such inflows are, of course, welcome, but they pose yet additional challenges to the monetary policy. In broad terms, and now that we have to close this second round, I would like to summarize the following takeaways. After several complex years when we have observed both supply and demand shocks that required a very active monetary policy in the region and in the countries represented here today. Going forward, we can say that the outlook is that of normalization. Over the past years, monetary policies had to face many challenges in partially dollarized economies, and central banks had to increase intermediate variables that had to be monitored. In some cases, they had to focus more on the foreign exchange rate due to the implications that this component can have on the balance sheet of the financial system and enterprises. This is no doubt quite a challenge to the different economies, and therefore efforts are required in order to reduce exposure of the different economies to this risk. Now the time has come to share with you the questions we have received from the audience. We have many questions, but for the sake of time, we have handpicked some questions to share with speakers. We are going to start this Q&A session with Joel. So here's the question. Do you believe that the monetary policy in a partially dollarized economy has become more effective during the spillover stage following the implementation of monetary policies in the United States? Joel, you have the floor. Please go ahead, Joel. Well, thank you for the question. It's quite an interesting question. I believe that the strengthening of monetary and foreign exchange schemes in the region and the macroeconomic fundamentals have all borne their fruit. The work carried out over the past decade led the region to be more resilient to shocks. In the face of post-pandemic inflationary pressures, the region took one step ahead, compared to the central banks of advanced economies did. Interest rates were increased quite markedly. And as a result, most countries in the region with a specific target rate have inflation factored in. Therefore, central banks have been able to react before at the advanced economies. For the past years, we have observed how central banks have been normalizing their monetary policy rates. Now, interest rate differentials compared to the United States have narrowed down. In the case of the Dominican Republic, they have hit a historic record low. However, in 2013, as a result of the taper tantrum, we haven't observed pressure on capital inflows or on dollarization, internally speaking. I believe that two developments have contributed to these results. On the one hand, the strength of macroeconomic fundamentals have led to reducing risk indicators quite sharply. And as a result, credit ratings have also been notched up. International investors are now more willing to sacrifice their returns, but keeping their investments in the region. On the other hand, the deepening of foreign exchange markets and the use of derivatives, all that has exerted pressure on the markets, or as a result of which hedging has been put in place. And there has also been an anchoring of inflation expectations. Real interest rates have remained appealing in order to avoid the dollarization of domestic systems. Central banks, therefore, have been more independent to react to idiosyncratic shocks and having fully synchronized policy, or a policy that had to be fully synchronized with that of the U.S. Federal Reserve. Now we have another question for both Alonso and Sebastian. Based on your recent experience in your respective countries, which lessons have you learned as to how the monetary policy should react in the case of shocks, or the impact that these shocks could have on the price of energy or on the economy at large? Alonso, please go ahead. Well, first off, over the past 4 years, we experienced different shocks. First, the COVID shock, to be followed by the energy shock. And some unpopular measures had to be taken. The government decided not to grant subsidies when such shocks hit the country. At the time, it seemed that was the best way to go. That's what we learned from that period. Next, the inertia in the perception as to how the foreign exchange will behave. Even when we have had foreign exchange flexibility for more than 20 years, that situation still persists. If we used derivatives, we could reduce the risk to which the financial sector of the real economy are exposed. Even if we do not, we are not a country with a significant mineral markets or natural resources, we are exposed to those shocks because now there are many investors who are keen on the services industry. So that's another lesson, and we have to see how the monetary policy will react in the face of these vulnerabilities. We will have to decide how we prevent them from becoming vulnerabilities. In fact, another element has to do with the fact that people react to incentives, but in the financial sector, we see that active rates are still rather slow. So we are trying to promote better conditions in the financial sector in order to boost competition in the financial sector. Thank you very much. Sebastian, your turn. Thank you. Well, our first takeaway lesson is the following. That shock was quite complex, taking into account the different implications or effects they could have on commodities prices, energy prices, transportation, more trade fragmentation, among others. As a result, responding to this shock is quite a complex situation. Second, we've learned that the monetary policy has to be implemented in a thorough and cautious manner, taking into account that these shocks are normally tied to a high degree of uncertainty due to geopolitical developments. There is uncertainty, for example, about how persistent a given shock might be, and as a result, it might be more difficult to decide whether you're going to apply more a contraction monetary policy or not. When during the last phase of these shocks, we had to analyze, for example, the impact of these shocks on oil prices, because usually such oil prices tend to overshoot. I believe the monetary policies, therefore, should always be conducted in a conscious manner, taking into account the high degree of uncertainty tied to these types of shocks that take place in a scenario filled with geopolitical tension. Adolfo, what about the recent development of public debt denominated in foreign currency in Uruguay, and what about their implications for the effective management of the country's monetary policy? Thank you very much for the question. Regarding the de-dollarization policies implemented in Uruguay, we should mention the reduction of public debt denominated in foreign currency. By implementing two strategies. On the one hand, there has been a reinforcement of the local market, in a context of low inflation and with the anchoring of inflation expectations. This scenario has been favored. Uruguay has issued pesos denominated bonds we have been increasing this participation for many years by now. But the central bank still participates in this process to improve communication locally, as well as the communication with international stakeholders that might be keen on investing in local currency denominated public debt. Uruguay has carried out these bond issuances linked to the Uruguayan pesos quite successfully. I would say that the degree of dollarization of public debt is below or lower than 50%, taking into account total public debt. If we analyze the figures 20 or 30 years ago, 25 years ago, in the case of Uruguay, that was an economy that was virtually fully dollarized. With regards to its public debt, I would say that this is quite a significant change that has transpired. Going forward, we have to analyze internationalization of local debt. That is something that we will have to factor in to challenge our monetary policy. And we will also have to focus on the implementation of the public debt policy implementation. And at the same time, we will continue working on debt markets that are local markets. Thank you very much, Adolfo. Unfortunately, we are running out of time. We would like to have much more time to be able to address all questions. All the same, I would like to thank Alonso, Sebastian, Joel, and Adolfo for sharing your insights with us and for answering these questions. One, a closing remark. Despite how difficult managing monetary policy or macroeconomic policies and the monetary policy in particular, I would like to say that the region has been making steady progress in handling inflation that is really not worthy. Partial dollarization in many economies is no doubt a limitation to implementing an effective management of macroeconomic policy, and this is one of the topics that we wanted to address today. Today, we have shared this webinar with representatives from 4 institutions from countries that face this kind of challenges in the region, and they have made it clear that even though we are faced by a significant challenge, their institutions have been able to learn and implement strategies in order to overcome these restrictions in order to work towards achieving the target set. I'm sure that all the lessons learned will also be important for other countries in the region that might have to face macroeconomic challenges in two currency monetary systems. I'd like to thank all speakers and the audience for your interest and participation in this webinar. Thank you very much and have a nice day.